Time now to review the U.S. consumer price inflation landscape. In order to do that, our chief equity strategist and economist John Blank looks at six U.S. inflation measures using percentage changes from a year ago. Here now to do that is John. John, first of all, what are those six inflation measures?
Well, we've got median inflation measures. We've got sticky price inflation measures. We've got the CPI, which I will talk to today from the Bureau of Economic Analysis or Bureau of Labor Statistics, BLS. And then we've got core PCE, which is what the Fed likes, which is from the Bureau of Economic Analysis, BEA. So all of these are, giving us a year-on-year trend on the consumer price inflation. I have before me through March the CPI, all items, which is known as the broad CPI, is at 2.4%, and all items less food and energy, which is taken out because they're typically more volatile, is at 2.8%. So at least those are two-ish numbers, and they're below three. And over the last year or so, we've seen this get ticked down about 3 or 4 tenths, maybe 5 tenths over the last year. So we are getting the Federal Reserve, pressure, being applied, very, very delicately to these numbers, and it is bringing them down very carefully.
What are some other key takeaways from your review of these measures?
Well, you got to get into the details here, Terry. And one of the big details is what's called shelter costs, which is 40% of this number. And shelter costs, unfortunately, through March, for the last 12 months through March, is 4% annual. So if you're doing 2.8% less food and energy, and 4% is coming out of that bunch of rent, that's telling you the housing market, housing costs are still squeezing consumers, keeping people in homes that they may otherwise have sold after COVID, and that we're just finding there to be a lot more demand for shelter than there is supply. And this is the enduring part of the consumer price index that does get to the sticky price question, and it is the stickiness that's continuing to play out.
So, bottom line, is consumer price inflation on the rise? And can you adequately size up U.S. inflation without also looking at the wholesale price inflation?
Well, I think 2.4% on the broad CPI is getting very close to what the Fed would be comfortable with, and that is baking in energy move down of minus 3.3%. So within the economy, when you talk about commodities and energy commodities in particular, you're getting a decent pullback in them that's helping out keep broad CPI below core. So we have yet to see what happens with the tariffs, or even how they play out or how they hit. But that would be more of an effect that would be going forward, not looking back. And I'm talking about numbers that are looking back from March 2025 to March 2024.
Okay, kind of looking forward a little bit more. What do you think about prospects of stagflation this year?
Well, Terry, that's more talk than action, because of the waffling and changing of policies by this administration. It is a wait and see uh, outlook for the growth rate of the U.S. economy, the real growth rate of the U.S. economy. It's also a wait and see outlook to see, how the CPI plays out month to month going forward over the next 8 months. We are through basically a third of this year already, and that third of the year is fine. It's the next half a year, particularly the second half, uh, that we got to watch out for. But again, there's been way more worry than there has been substance in the numbers that have come out, and that is just part of the mix of having a frantic reach to the media through the populist regime we elected, and the reality of macroeconomics, which is it's all 330 million of us, and we take our decisions, and frankly, a lot of us don't even pay attention what's in the news.
What about the prospects for a recession this year, or maybe just a meaningful slowdown given the tariff situation?
Well, Terry, you can go to this site called Polymarket. I'm going to do it right now. And Polymarket right now says U.S. chance of recession in 2025 at 53%. It has been well above, it moved from 40% in the 1st of April to 50%, 53% now on the 24th of April. So the last 3 weeks, we've added 10% to the recession chance of the United States through the chaotic policies of this administration. The good news is that's down from 65% at the April 2nd announcement. So that's showing you this relationship, which is that the market gets more bearish about a recession, the tariffs get pulled back, and the recession risk goes down. So there's this dance between recession probabilities and people telling the president and the administration about them, and then getting that reciprocal lowering of tariffs or at least pushing back the timelines. And ultimately, it turns what these tariffs are turning into is more of a media event than a reality.
Do we need to see some good news regarding tariffs in order to see some optimism on the U.S. economy, especially given the trade war with China?
Well, you got to remember, tariffs, Terry, are for goods generally, and goods are not a very large percentage of the U.S. economy or our service economy. So the truth is, service economy jobs can carry on as long as the pressure downstream from the goods inflation that comes through the tariffs doesn't overwhelm the spending on services. And so, for a lot of people, like I talked to you about the shelter costs earlier, people it's generally telling you there's still spending pressure out there, and it's falling on housing, on goods and services, and with services being a bigger number. And at the end of the day, this is what, and again, one of the problems people have about macroeconomics and news cycles about tariffing is talking about a very small percentage of maybe the U.S. economy, because the tariffs are on foreign goods, and that's 7% maybe the U.S. economy at best, import and export. And it leaves it under 93% goods that are domestic or U.S. services that are just simply not in play with this whole story.
Speaking of tariffs still, Fed Chairman Powell said last Friday that the Fed is going to stand down on rate cuts in light of them. What do you see that meaning? That was a big media event as well. What do you see that meaning for Fed policy this year?
Well, Terry, I've told you earlier, and I'll tell you again, 2.8% is the core CPI for the U.S. economy, and the core PCE, which is what Powell would care about, is 2.6. And the sticky price and median price that track that are in the 2.5-ish, 7.58. So they're basically telling you 2.6 is really what the economy is doing in inflation. And Jerome Powell has a statutory mandate, a legal mandate, to bring that inflation rate to 2% annually. And so he has to acknowledge that by keeping his short-term policy rate, stable and at a restrictive level. So, when the president says cut rates, what he means is, I'm going to do damage to the price system and the growth, and I want you to cut rates. And Powell's saying, look, even now, before anything you were doing, through March, I have a 2.6% core PCE rate I need to keep policy restricted because of the existing need within the economy, not additional pressure from the administration. So this is the situation. And again, the Fed operates not and beholden to the president, which is good. And it operates to a statutory mandate, which is to bring that inflation rate down, which will mean they will keep surprising this president because they're going to keep restriction higher than he would like.
Is there a way to tell how long it might be before, if ever, economic uncertainty translates into a major decline in consumer confidence here?
That's impossible to know, Terry, because there's a disconnect between what policy trade uncertainty is. The Fed measured it as the sheer amount of news, trade war, tariff sanctions in the news. They count it up across their sample of news sources, and what people actually pay attention and do about. And they're basically what you learn, particularly in a fragmented media landscape like this one, that people don't have a very good understanding of how serious they should take anything, and they'll carry on until as long as their job's in place. And so the job market is in the private sector outside of Washington, D.C. in good shape. And in the news we're getting out of Doge, is a 280,000 job losses, mostly in D.C. And again, 280,000 job losses in an economy with 162 million people working in the civilian labor force. That's peanuts, Terry. And again, this is the problem with, and why we're doing this podcast, is macroeconomics often creates an exorbitantly large number in the face of news cycles, which are constantly projecting the Doge and the tariff uncertainty, and it all doesn't add up enough to a massive, massive aircraft carrier like the U.S. economy.
What does the global economic picture look like?
Well, the IMF spring meetings with the World Bank were underway recently, and they are basically, along with it, giving their outlooks to the various finance chairs that come into DC. And they cut a couple tenths of percent off of the GDP growth rate on the trade policy uncertainty coming out of the United States, but that still leaves it about 3%. And we still have very strong economies, and we've still got stimulus coming out of Europe. And frankly, China is chugging along just fine with their, 4.5%, near to their 5% target. India is just fine. The world economy over the last 20 years, Terry, is significantly larger outside the U.S. than it ever has been. So you got to keep that in mind too. The rest of the world is going to shrug its shoulders more than most people understand.
As far as stocks on your radar, you picked two major Japanese conglomerate stocks, one U.S. financial firm, Sony, Hitachi, and CME Group.
Yeah, absolutely. In segue with the global economy, we go to Sony, ticker SONY. We've got a target price of 27. It's at 25. A B for value, a B for growth, and a number 2 rating. Stock's been trending higher from 16 in the middle of 2016 to 24 now. And we got a 4% growth in their earnings. Not too strong, but certainly nothing to shrug your shoulders about for a Japanese economy that doesn't grow more than 1%. So what this is telling you is Sony is telling you the global economy is just fine because they are a global company.
Hitachi,
3.4% annual growth this year for their earnings. Again, that's not stunning, but it's certainly nothing that's outperforming the Japanese economy, which is typically 1%. So again, they're a global multinational that's giving you a number like the IMF has thrown out there in the 3s, and we've got a number 1 rating on the stock. So you got to like it. High beta or low beta, these are typically very low beta stocks, Terry. This is a 0.75.
CME Group.
CME Group, why would we talk about this? This is exactly what happens with trade volatility. It spins the VIX options volatility index up. Their S&P 500 futures trade on that volatility day to day. Their trading firms make a lot of money. They trade a lot more. And this company, the exchange back end, really makes a lot of money. So here you've got a 5% growth in earnings for this year and a number 1 rating. I would tell you that the stock has been running hard into this, and this is one of those examples where I probably would be a seller, not a buyer, because I think all the good news is priced in on CME Group.
Our chief equity strategist and economist, John Blank, on inflation and more. With John, I'm Terry Ruffalo.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.